This chapter is a short, practical how-to, a compact checklist that tells you what to look for when you found a stock worth investigating. Lynch's point up front is reassuring. You don't need to become an accountant or spend weeks doing this. A couple of focused hours per stock will usually do it. The trick is to do the right checks and to do them with the appropriate expectations for the kind of company you're evaluating. First, the general rules that apply to every stock. Check the P/E ratio. Is it high or low relative to the company's history and its peers? Look at institutional ownership. The fewer big institutions own it, the more likely you found something overlooked. Insider buying and company buybacks are positive signs. Management putting skin in the game or shrinking the share count aligns interests with shareholders. Look at the earnings record. Have results been steady or erratic? Finally, check the balance sheet and cash position. Lynch gives the Ford example. When Ford had about $16 of net cash per share, that set a practical floor under the stock and changed how risky it felt. Then the chapter breaks the work down by the 6 stock categories Lynch uses throughout the book: slow growers, stalwarts, cyclicals, fast growers, turnarounds, and asset plays, and gives the specific items you should verify in each case. Slow growers. These are dividend plays. Your first question: will the dividend hold up? Look for a long history of steady or rising payouts. Find out what percentage of earnings the company pays as dividends. A low payout ratio gives breathing room in a downturn. A high one is riskier. Stalwarts, big, steady companies. The main concern is price. You want to know whether you're paying too much. Check the P/E. Watch for diversification, fancy unrelated acquisitions that dilute focus and hurt long-term profits. Check how the company fared in past recessions. Some stalwarts are great defensive holdings. Others were simply overpriced at the wrong time. Cyclical timing and industry knowledge matter here. Watch inventories and supply/demand trends, and be alert for new entrants that could push margins down. Expect that P/Es will compress as a cyclical industry recovers and the market looks ahead to peak earnings. If you know the cycle well, cars, steel, or airlines, for example, you have an edge. Fast growers. This is the land of 10 baggers but also of danger.